Welcome back to Stock Spotlight. I'm Michael, your host. Usually, I'm analyzing one company in depth, but today, I'm pulling back the curtain on the process itself. These are the metrics that shape how I think about most investments. When I evaluate a company, I try to strip away the noise, the headlines, the guidance drama, the story stocks that come and go. What I care about is simpler and far more enduring. How consistently does this business generate real cash? How wisely does it reinvest that cash? And how resilient is that engine through different market cycles? Over time, I've built a set of 15 core metrics that I come back to again and again. Each one tells me something specific about the quality and durability of a business. I group these 15 metrics into 5 broad categories: value creation, which is how efficiently capital compounds; cash flow quality, which is how cleanly profits translate to cash; business model and management, how disciplined and scalable the cost structure is; innovation efficiency, whether R&D truly drives growth; and solvency, the financial strength that lets a company play offense in a downturn. Because when you understand these metrics, you don't just see what a company does, you see how it builds lasting value. Now, let's dive into value creation. For value creation, the first metric that I want to talk about is free cash flow per share, which is owner earnings per diluted share. How to calculate it? Free cash flow per share is just operating cash flow minus CapEx divided by diluted shares outstanding. I like it because it's a direct measure of what actually accrues to shareholders and serves as a North Star for long-term compounding. In terms of application and utility, you want to track long-term free cash flow per share growth, and I like to use it to rank ideas and sanity check whether value is truly compounding on a per share basis. A few things to watch out for include one-off working capital swings and buybacks that mask flat total free cash flow and stock-based compensation dilution, which can distort trends year to year. Next, ROA, or return on assets. It is a profitability measure relative to the total asset base. How to calculate it? ROA is just simply net income divided by total assets. I like it because it's a clean view of how efficiently a business converts its assets into profit. And an alternative to ROA is something called operating ROA, where you take operating profit and divide that by total assets. Now, ROA is best used within an industry to compare asset productivity and capital efficiency among peers with similar balance sheets. Like ROE, it's useful for banks and financials, and it's often compared with the effective interest rate on debt to determine financial leverage gain or loss. Couple watch-outs for ROA. Asset-light businesses will naturally post higher ROAs, and you do want to think about adjusting for intangibles or off-balance sheet assets to avoid distorted comparisons, and don't use this across industries. Next, ROIC, or return on invested capital, which is the return on all capital deployed in the business. At the highest level, ROIC is equal to NOPAT divided by the average invested capital, and usually averaging over 2 years is standard practice. From there, invested capital has many different definitions, but if you see some of my posts on X, I go in depth into my own definition. And I like it because it's the foundation of business quality, and sustainability above the cost of capital, or WACC, indicates a durable advantage. In terms of application utility, you also want to compare this within industries and against a consistent WACC, and use trend lines to see if advantages are strengthening or fading. 2 watchouts: invested capital definitions do vary. Some people include goodwill, leases, excess cash, others do not, so just pay attention to the formula that the website uses or that you calculate yourself. And you want to just be consistent across names and time. There is also one alternative equation that's called free cash flow ROIC, and it's simply just taking free cash flow divided by that average invested capital. Next, ROIC, or return on incremental invested capital, and this is just the return on the next dollar invested. To calculate it, you take the change in NOPAT divided by the change in invested capital. I like it because it's a forward-looking quality signal that helps you see if the current leadership team is making smart money choices. A high ROIC but low ROIC might mean new management is fixing past mistakes. I like to use it with the reinvestment rate to calculate a company's value compounding rate. And a few watchouts here, it can be very lumpy year to year, and acquisitions, asset sales, or accounting reclassifications can distort this number. And then I'd also recommend using or at least think about using a multi-year rolling window to smooth out some of that noise. And then also if ROIC drops below ROIC, that could be a warning sign that new investments aren't working as well as older ones. In terms of alternative equations, you can also calculate a lagged ROIC by comparing the change in NOPAT in a given year to the investments made in prior years. See my post history on X for this equation. There's 2 more metrics for the value creation section of my 15 key metrics. So the 5th key metric is reinvestment rate, which is the percent of NOPAT reinvested into growth. To calculate it, you just take the change in invested capital divided by the cumulative NOPAT for a certain time period. And I like it because it shows how hard the compounding engine is being pressed. And it's great to pair with ROIC to judge the quality and productivity of reinvested capital. And you want to track directionally over time. So rising reinvestment is positive only if incremental returns stay above the cost of capital. And there's no right level universally. It really depends on how effectively each company can reinvest at attractive rates. In terms of watchouts, just know that high reinvestment isn't inherently good. It can destroy value if returns fall below the cost of capital. Likewise, low reinvestment can signal either maturity or strong capital discipline. Our 6th key metric ties in the last 2, and it is value compounding rate, or VCR for short. This is the internal growth rate of intrinsic value per share, driven by the combination of return on capital and reinvestment rate. So it tells you how fast the business itself is compounding before valuation changes. In terms of how to calculate it, VCR equals ROIC times the reinvestment rate. I like it because it's the engine of long-term compounding. High ROIC and high reinvestment create exponential value growth for an investor, and it blends quality with growth into a single, nice, intuitive number. In terms of application utility, I'd recommend using VCR to estimate intrinsic value CAGR over 5 or 10 years, and to bridge from business performance to expected total shareholder return. For example, a firm earning 20% ROIC and reinvesting 50% compounds intrinsic value at around 10% annually. This makes it ideal for ranking compounders or watchlist companies by quote-unquote velocity of value creation. In terms of watchouts, it is sensitive to noisy ROIC inputs, so you want to smooth over multi-year windows. And it can overstate growth if M&A reinvestment earns declining returns. And then remember, VCR measures business compounding, not stock returns. Now our next section, cash flow quality, has 2 key metrics that I like to use. The first one is free cash flow conversion. This measures the quality of a company's cash flow generation, and you calculate it by taking free cash flow per share divided by diluted earnings per share. I like it because it signals whether reported earnings translate to cash that owners actually receive. You can use it to flag clean cash generators versus accounting heavy stories. And then also stable or rising conversion is a positive durability signal. For some watchouts, it is volatile due to timing of CapEx and working capital, so I would never recommend to rely on a single year or quarter. And then I also recommend setting a benchmark. For me, I like 75%, but yours may vary. And really anything 100% or greater is excellent. All right, now we'll turn our attention to the 8th key metric, which is SBC adjusted free cash flow margin. And this is just simply free cash flow margin after subtracting stock-based compensation. So to calculate it, you just take free cash flow minus stock-based compensation and then divide that by revenue. Now, this is a profitability ratio indicator that shows how well a company is converting sales to cash. For application utility, it's great to normalize SaaS and high growth comparisons. and use alongside SBC intensity for a full picture. It is different than operating margin in that operating margin measures the profitability of a company's core operations, while free cash flow margin focuses on the cash generation efficiency. In terms of a benchmark, I like to set mine at 15%, but most investors will use 10 to 15% as a quote-unquote good free cash flow margin range. I do have a few watch-outs too. If SBC is truly minimal, then you don't really need to adjust for it to calculate free cash flow margin. Also, if a company is very capital intensive, it might have a free cash flow margin lower than its net margin level, and vice versa. Also, if ROIC is lower than free cash flow margin, then it means that the company has probably been stockpiling cash or working capital. All right, our next section is business model and management, and our ninth key metric is operating leverage, and this is the sensitivity of operating income, or EBIT, to changes in revenue, which essentially just means how much profit moves for each dollar of sales movement. To calculate operating leverage, you just take the percent change in operating income and divide by the percent change in revenue. I like it because it reveals the scalability, or in some cases fragility, of a company's cost structure. High operating leverage can magnify upside in growth periods, while low leverage provides resilience when revenue slows. For application utility on this one, I recommend tracking through cycles to identify margin inflection points and the durability of expansion. I'd also recommend using it alongside margin beta, which just missed the top 15 metrics. And margin beta is simply the slope of the change in EBIT margin versus revenue growth. And this will allow you to quantify how sensitive profitability is to revenue swings, a proxy for earnings volatility and business model stability. I have posted on X about both of these metrics, so feel free to check my post history. Do have a few watch-outs as well. Watch out for one-off items, restructuring charges, or mix shifts that can distort year-over-year EBIT changes. Note that operating leverage greater than 1 amplifies both gains and losses, which is common in asset-heavier fixed cost models, while operating leverage less than 1 signals a flexible, variable cost structure. Finally, normalize over multi-year periods to filter out the noise and better understand true cost behavior. Our 10th key metric is one of my favorites, and it is CapEx intensity, which is simply the share of revenue reinvested into property, plant, equipment, and technology infrastructure, and it's a measure of ongoing capital intensity of the business. So you calculate it just by taking CapEx and dividing by revenue, and I like it because it highlights the capital required to sustain and grow the business. Lower CapEx intensity usually signals more scalability and financial flexibility, while higher intensity implies heavier reinvestment needs, but can also reflect defensible capital moat industries. Think utilities, railroads, and telecom. In terms of application utility for this one, I find it very useful for modeling free cash flow conversion and forecasting how scalable a company's cash generation can be as it grows. You do want to compare within industries, as asset-light industries like software and payments often run near 1 to 3% of revenue, while asset-heavy ones like industrials, energy, and transportation can exceed 10 to 15%. What I did find using the NYU latest data set is that the all-company average in the US is around 4% of revenue. A few watch-outs. Some CapEx light spending never actually appears in CapEx. So for example, R&D, content creation, and customer acquisition are expensed, but do serve similar purposes. So watch out for growth versus maintenance CapEx distinctions if the company does provide that info. So our 11th key metric is another intensity metric, and this one is stock-based compensation, or SBC intensity, and it measures how much a company's revenue is paid to employees and executives in stock. You calculate it by taking stock-based compensation divided by revenue, or you can take stock-based compensation and divide it by operating cash flow. For SBC as a percentage of operating cash flow, I do prefer this, but note that there's going to be fewer benchmarks online, but I do believe it's a powerful way to see how much of that cash generation is being given back through dilution. I like this metric because it reveals how growth is being financed, whether through true operating leverage or shareholder dilution, and it's a subtle read on management's capital discipline mindset and alignment with owners. You'll want to benchmark this across peers and within an industry, and then also track multi-year trends. A steady or declining ratio probably signals maturing profitability and disciplined incentive design, while a rising intensity can indicate growing dependence on equity financing or compensation misalignment. One watch out here is that not all SBC is created equal. Some grants are there just to retain existing employees, while others represent new compensation that adds dilution. SBC can also be defensible during high growth phases, but persistently high levels, and especially if they're offset by buybacks, can mask real dilution and drag on per share economics. Our 12th key metric and our last intensity-based metric is acquisition intensity. And this is simply the share of operating cash flow spent on acquisitions. And it's a measure of how dependent a company's growth is on inorganic expansion. You want to calculate it by taking the M&A cash spend or acquisitions on the cash flow statement and dividing it by operating cash flow. I like it because it separates organic builders from serial acquirers. It's one of the clearest signals of management discipline, too. And sustained low intensity often reflects a self-sufficient compounding engine, while high intensity can work if integration and returns are strong, but it raises execution risk. For application utility here, I do recommend using multi-year averages, at least 3 to 5 years, to smooth out M&A cycles. And then you can also combine with ROIC or ROIC trend lines to see whether acquired capital is earning its keep. Also, I have a little interpretation guide that I use personally for this metric. Anything less than 10%, I call low reliance on M&A, which is an organic growth engine. Anything between 10 and 30%, I call moderate reliance, and these are companies that have strategic bolt-on acquisitions, or what they sometimes call tuck-ins. And then anything greater than 30%, I have high reliance or high acquisition intensity. And these are usually serial acquirers or companies with that consolidator model. In terms of watchouts, I do see this with quite a lot of companies where one-time mega deals can distort averages, so I do recommend using medians where possible. And then integration and restructuring costs are often capitalized or excluded, so just note that that can understate true spend. And then look for follow-on dilution or debt increases after acquisitions to gauge the total cost if you do want to do that work. Our next section, which only has one metric, innovation efficiency, and the metric is R&D efficiency. And this measures the return on innovation spend, or how effectively a company's R&D investments translate into future growth and profitability. The formula sounds a little complicated, but it's not too bad. So I'll just give an example. If you were to calculate 2024 R&D efficiency for, let's say, company A, you'll take the average revenue growth percentage in 2023 to 2024, and then you'll divide that by the average R&D percentage of revenue in 2022 to 2023. So note that this introduces a 1-year lag for R&D spend, which reflects the additional time it usually takes for innovation to impact results, and it smooths out volatility by using those 2-year averages. I like it because it confirms whether innovation dollars actually create economic value, and by linking R&D spend to subsequent growth, it shows which companies are turning ideas into returns rather than just chasing headlines. For application utility here, I recommend tracking on rolling multi-year windows to see if R&D productivity is improving. You can also compare across peers and pair with ROIC to validate whether reinvestment is compounding efficiently. A high R&D efficiency score signals a durable innovation engine, while declining trend may hint at diminishing returns or overinvestment. A couple of rule of thumbs, and this does change by industry, but generally for me, anything greater than a 1.5 ratio indicates strong R&D efficiency. Any ratio between 1 and 1.5 indicates moderate efficiency. And then anything less than 1.0 would be weak or lagging ROI on R&D. In terms of watchouts, just note that R&D payoffs lag by several quarters or even multi-years, so short-term drops don't always mean inefficiency. Acquisitions can also inflate results by boosting growth without prior R&D expense. And then finally, note that capitalized development or software cost may obscure the true R&D load and adjust if possible. And I'll give one example. So if a company averaged 15% revenue growth over 2 years and spent 10% on revenue on R&D over the prior 2, then their R&D efficiency is 1.5. That means for every 1% of revenue spent on R&D, revenue grew by 1.5%, which is a pretty solid return on innovation investment. Now, to round out our 15 key investing metrics, we'll talk about the last section, which is solvency. And there's many metrics that I could have chosen here, but I boiled it down to 2. And the first one is debt to free cash flow, which measures how many years it would take for a company to repay its total debt using current free cash flow, which is a clear, intuitive read on debt paydown ability. To calculate it, you just take debt divided by free cash flow. I do recommend using latest quarter total debt to capture current obligations, and then trailing 12-month free cash flow to smooth out seasonality. You can also use net debt if you prefer. Now, why I like it. Analysts often quote debt to EBITDA or net debt to EBITDA because it's quick and standardized. But here's the thing. EBITDA isn't cash. Debt to free cash flow, on the other hand, measures how long it would actually take to repay debt using real post-CapEx cash generation. It tells you what the company could do if it stopped all optional spending and just focused on paying lenders back. In terms of application utility, I recommend using mid-cycle or multi-year average free cash flow to avoid peak year distortions, and then compare across peers and over time to assess debt sustainability, and then also pair it with our next metric, interest coverage, and maturity schedules that you can find on the 10K for a fuller picture of a company's financial flexibility. I also have an interpretation guide for you all. So anything less than 3x is what I would consider strong coverage and or conservative leverage. And then a ratio between 5 and 6x to me indicates moderate leverage, and it is acceptable in certain capital heavy sectors. And then anything greater than 10x to me is elevated risk and likely reliant on refinancing or some sort of financial engineering. Watch out for cyclicals, as they can look the safest at the wrong time, as peak free cash flow inflates coverage. Also, adjust for lease liabilities, any working capital swings, or asset sale proceeds that might temporarily boost free cash flow. Finally, if free cash flow is negative or unstable, then feel free to fall back to that debt or net debt to EBITDA metric as a directional check. All right, we're now in our 15th and final key investing metric, and this one is interest coverage ratio. It's a solvency ratio that measures how easily a company can pay interest on its outstanding debt using operating earnings or EBIT. To calculate it, you just take EBIT divided by interest expense. And I usually like to do this on a yearly basis, although you can calculate it each quarter as well. I like it because it captures resilience under stress, and a company with high coverage can weather downturns and still meet those debt obligations. Benjamin Graham also set a minimum standard of around 5x, while values below 2x signal potential heavy debt burden. And in terms of application utility, like I just mentioned, I'd recommend annual or trailing 12-month data for longer-term analysis, although quarterly data can catch early stress signals. You also should compare this within industry norms, as financials and utilities naturally run lower leverage and tech and services higher. Pair it with debt to free cash flow to gauge repayment capacity, and then one we didn't talk about, but another one I like called cash to debt to assess short-term liquidity. So in terms of interpretation guide, anything greater than 10x to me is excellent. It's a strong buffer with little default risk, and you'll see in my research checklist that 10x is the threshold that I have. A company between 5 and 10x to me is still healthy and stable. Anything between 2 and 5x is manageable, but I would watch the cyclicality here. And anything less than 2x indicates a potential risk zone and a company vulnerable in downturns. I also found it interesting that based on Graham's work and updated corporate credit spread data, firms under 2x often correspond to a B+ or below credit rating. So just something to think about there. And then for watchouts, just note that this doesn't capture principal repayment, only interest service. And cyclical companies may look fine at peak EBIT, but collapse in downturns. So you can consider EBITDA coverage if non-cash charges distort EBIT. In closing, these 15 metrics form a complete picture of business quality, not just what a company earns, but how it earns, reinvests, and sustains those earnings over time. Value creation metrics reveal how effectively capital compounds. Cash flow quality shows how cleanly earnings convert to cash. Business model and management captures the discipline, scalability, and integrity of a company's cost structure and capital allocation. Innovation efficiency measures whether R&D spending actually drives growth. Solvency determines who can play offense when conditions tighten. Each metric tells a story, and together they show whether a company's growth is real, repeatable, and resilient. No single ratio wins on its own. The power lies in the pattern. When free cash flow per share is rising, ROIC stays high, reinvestment remains disciplined, and debt to free cash flow stays manageable, the stock price usually follows. That's the framework I use to understand compounding at its source, the business itself. If you enjoyed today's episode, drop a comment or take the episode poll. For real-time updates, follow me on X at invest091. Tune in next time for our deep dive into Cboe Global Markets, ticker symbol CBOE. Until then, keep your investment smart.